Investing is often portrayed as a straightforward path to wealth. Buy low, sell high, follow the data, and watch your money grow. Yet, for every story of financial triumph, there are countless tales of losses, missed opportunities, and portfolios decimated by poor decisions. How Not to Invest: The Ideas, Numbers, and Behavior That Destroy Wealth, and How to Avoid Them, offers a sobering yet empowering exploration into the most common pitfalls of investing, unraveling the psychological traps, flawed strategies, and misconceptions that can erode even the most promising fortunes. At the heart of the book is a simple premise. Most investment failures are not the result of bad luck or unforeseeable market events, but of avoidable mistakes. The author draws on decades of research, real-life case studies, and behavioral finance to show how investors, both novice and experienced, fall prey to the same errors time and again. The journey begins with an examination of the seductive, but often dangerous, ideas that permeate the world of investing. One of the most pervasive myths is the belief in easy riches. The author recounts how, time after time, investors are lured by promises of outsized returns, whether from the latest hot stock, a newfangled financial product, or a charismatic fund manager. The narrative is filled with cautionary tales, dot-com darlings that crashed, real estate bubbles that burst, and cryptocurrencies that soared and plummeted. In each case, the underlying lesson is clear. If something sounds too good to be true, it probably is. Chasing after windfalls rarely ends well. Equally damaging is the tendency to believe that investing is a game of skill alone, where intelligence and analysis will always triumph. The book dismantles this illusion by highlighting the role of randomness and luck in financial markets. Even the most sophisticated investors are not immune to the unpredictable swings of the market. The author cites research showing that many top-performing funds owe their success more to chance than to skill, and that past performance is a notoriously unreliable predictor of future results. This recognition is humbling, but it also frees investors from the pressure to constantly outsmart the market. Numbers, of course, play a central role in investing, but they can also mislead. The book delves into the common numerical traps that ensnare investors: over-reliance on short-term returns, misunderstanding risk metrics, and falling for statistical illusions. For example, many are tempted to chase funds with the highest recent returns, not realizing that these are often the riskiest and most prone to reversal. Others are swayed by complex charts and technical indicators, mistaking patterns for predictability. The author urges readers to look beyond the surface, to understand what the numbers really mean, and to question the assumptions behind them. Yet, perhaps the most insidious dangers lie not in the numbers, but in human behavior. The book draws extensively on the field of behavioral finance to explain why investors so often act against their own best interests. Fear, greed, overconfidence, and herd mentality are powerful forces. When markets are rising, it is easy to become overconfident, to believe that the good times will last forever, and to take on excessive risk. When markets fall, fear takes over, leading to panic selling and crystallized losses. The author provides vivid examples of how these emotions can override rational judgment, leading to poor decisions at precisely the wrong times. To counter these tendencies, the book offers a range of practical strategies. First and foremost is the importance of self-awareness. Investors are encouraged to recognize their own biases and emotional triggers, to set clear investment goals, and to develop a disciplined process for decision-making. The author advocates for a long-term perspective, emphasizing that wealth is built over years and decades, not in days or weeks. This means resisting the urge to constantly tinker with portfolios, to chase fads, or to react impulsively to market news. Diversification emerges as a key theme. By spreading investments across different asset classes, sectors, and geographies, investors can reduce the risk of catastrophic losses from any single bet. The book explains how proper diversification is not about owning a little bit of everything, but about understanding correlations and constructing a portfolio that can weather a range of market environments. Another crucial lesson is the value of simplicity. The author argues that the best investment strategies are often the simplest: low-cost index funds, regular contributions, and periodic rebalancing. Complex products and strategies may promise higher returns, but they also come with higher fees, greater risks, and more opportunities for mistakes. By keeping things simple, investors can avoid many of the traps that ensnare others. The book also addresses the role of professional advice. While financial advisors can provide valuable guidance, the author warns against blindly following recommendations without understanding the underlying rationale. Investors are urged to ask questions, to seek transparency about fees and incentives, and to maintain ultimate responsibility for their own financial decisions. Throughout, the book is infused with a sense of humility and realism. Investing is not about finding the perfect stock or timing the market with precision. It is about managing risk, controlling emotions, and making a series of sensible decisions over time. Mistakes are inevitable, but they need not be fatal. By learning from the errors of others, by questioning seductive ideas, by understanding the limits of numbers, and by mastering one's own behavior, investors can avoid the most common ways wealth is destroyed. In the end, How Not to Invest is less a manual for picking winners and more a guide to avoiding the losers. It is a call for vigilance, discipline, and self-reflection. By shining a light on the ideas, numbers, and behaviors that lead to ruin, the book empowers readers to chart a safer, more sustainable path to financial security. The real secret to investing, it turns out, is not in chasing the next big thing, but in sidestepping the traps that have ensnared so many before.